Hello and welcome to ASMO Tax Pro. If you're here, chances are you're looking to better understand payroll taxes in Canada. Whether you're an employee trying to figure out those deductions on your paycheck or an employer managing payroll, you've come to the right place. Let's break down everything you need to know about payroll taxes in Canada. Clearly, simply, and step by step. Now ready? Let's dive in. What are payroll taxes? Let's start with the basics. Payroll taxes are mandatory deductions that employers take from employees' paychecks and send to the Canada Revenue Agency, or CRA, as we like to call them. These taxes fund important programs like pensions, unemployment insurance, and the services we rely on. Here's the thing, payroll taxes are a shared responsibility. Employees pay a portion and employers also contribute their shares. So there are more going than just what you see on your pay stub. Components of payroll taxes. There are three main components of payroll taxes in Canada. Let's break down one by one. CPP, Canada Pension Plan. EI, Employment Insurance. Income tax. Let's talk CPP first. This is a saving plan to help Canadians have an income during retirement. It's available to anyone working in Canada, except for residents of Quebec, who contribute to QPP, the Quebec Pension Plan. Here's how it works. In 2025, both employees and employers contribute 5.95% of the employee's earnings to the CPP, up to a yearly maximum. The yearly maximum for pensionable earnings is $69,700, but the first $3,500 is exempt. For example, if you earn $60,000 in a year, you and your employer will each contribute approximately $3,573. If you're self-employed, you're responsible for both portions, which means a total contribution of about $7,146. Next up is EI, or employment insurance. This is a safety net if you lose your job, take maternity or parental leave, or even go to sickness leave. Here's what you pay. Employees contribute 1.73% of their insurable earnings, up to a maximum of about $1,300 for the year. Employers contribute 1.4 times of the employee's contribution. So if you're earning $50,000, your EI deduction will be around $865, and your employer will pay $1,211. Again, if you're self-employed, you'll need to register for special EI benefits and pay a reduced rate. Finally, we have income tax. This is probably the biggest deduction you'll see on your paycheck, and it's based on your total income for the year. In Canada, income tax is calculated at both the federal and provincial territorial levels. The exact rate depends on how much you earn and where you live. Let me give you an example. If you earn $50,000 in Ontario, your federal tax rate is 15% on the first $53,359, plus a provincial tax rate of around 5.05%. You'll also get some tax relief from credits like basic personal amount, which in 2025 is about $15,000 federally and varies provincially. Employers calculate this using tax tables or payroll software to ensure the correct amount is deducted every pay period. Employers' responsibility. Okay, employers, this part is for you. If you have employees, here's what you need to do to stay compliant with the CRA. Calculate deductions. You'll need to figure out how much CPP, EI, and income tax to deduct from each employee's gross pay. Tools like the CRA's Payroll Deduction Online Calculator or payroll software can make this easier. Remit deductions. You have to send these deductions along with your employer contributions to the CRA by the 15th of the following month. File T4 slips. At the end of the year, you must provide a T4 slip to each employee, summarizing their earnings and deductions. This is also submitted to the CRA. Penalties for missing deadlines. Now, here's a warning. If you miss payroll remittance deadline or calculate deductions incorrectly, the CRA can charge you penalties and interest. For example, late payments can cost you up to 10% of the amount owed. If it happens repeatedly, the penalties go up to 20%. That's why staying organized and keeping up with the deadlines is crucial. Here are some quick tips to make payroll easier. Use payroll software. Programs like QuickBooks and Wave can automate deductions and remittance. Set reminders. Mark payroll deadlines on your calendar to avoid penalties. Hire a professional. If you're overwhelmed, working with a payroll specialist like us at ASMO Tax Pro can save you time and stress. Employees, let's not leave you out. Your pay stub will show gross pay, what you earned before deductions. Deductions, the amounts for CPP, EI, income tax, and sometimes other things like health benefits or union dues. Net pay, what actually goes into your bank account. Take a moment to review your pay stub every time to make sure everything looks accurate. That's it for today's video on payroll taxes in Canada. Whether you're an employer, an employee, or even self-employed, I hope this video helped you understand the payroll taxes a little better. If you found this video helpful, make sure to like and subscribe to ASMO Tax Pro. And remember, if you need help with payroll or accounting, reach out to us at ASMO Tax Pro. Thanks for watching, and I'll see you in the next video. Bye for now.